FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and you are listening to the Financial Survival Network. I'm Kerry Lutz. It's December 18th, 2017. Well, men will come and go. Life will work its cycle, but the bubble is the bubble. And if it's not one thing, it will be another of that. That's something I can assure you. Well, housekeeping first. Be a part of the show. Love getting your emails. I think I'm only about 40 behind at this particular moment. I will get to them. It's my New Year's resolution to keep up on my steady, never-ending flow of emails that I get from you. So I will get to them. Hey, bubbles. So the bubble will live forever. And if you're into bubbles, well, you're going to love to hear from my next guest. His name is Doug Noland. You find him at creditbubblebulletin.blogspot.com. And hey, as a fellow bubble follower, I think you'll enjoy this. So, hey, there's so many bubbles going on right now that could one event blow up all the bubbles, or is it going to take multiple events? Good question. Well, here with us now is Doug Noland. Doug, thanks so much for coming on the show.
Hi, Kerry. Thanks for having me on.
Hey,
Appreciate it.
We love to get new guests. So what of bubbles? Do they always pop, or does the bubble grow to the sky?
Well, at this point, they seem like they grow to the sky, but I always have just a simple definition of a bubble. I know a lot of times the issue gets confused and it's more complex than many would imagine, but I just call a bubble a self-reinforcing but inevitably unsustainable inflation. And you can have bubbles in all kinds of things, right? You can have a bubble in the economy, asset prices, etc. The key here is that it's self-reinforcing. So these things tend to go on much longer than we bubble analysts would believe, but inevitably they always burst. So a lot of folks today think that the environment's sustainable. I say clearly it's a bubble. I don't know when it will be pierced, but there's also a dynamic that the longer these bubbles last, the more dangerous they are. They become more deeply embedded in the structure, and that's financial structure, economic structure. And as we saw in 2008, 2009, when they burst, there's a lot of pain. Let's just say there's hell to pay for bubbles, especially the terminal phase, the end of a bubble. Things get crazy, and that's when a lot of damage is done, but you really don't see that damage until the bubble bursts.
Yeah, so there's a certain inevitability to it, isn't there, Nathan? I mean, I'm sure you've studied them all. I mean, tulip mania, it's really a cliche at this point. It's really, everyone knows about it and everyone thinks, well, because we know about it, it's not going to happen to you. It's not going to happen to me. But yet people keep falling for the bubbles time after time throughout history. Why, Doug, do they keep falling for it? Why don't you learn from history?
Yeah, when we go, back in the history books and read about these, various financial fiascos, it's always like, how could that have happened? How could they have believed, those things they believed to ensure those bubbles unfolded? A lot of times I come back to, one of my favorite economists, Lawrence Kindleberger, and I'll paraphrase him, but he said one of the most powerful dynamics in economics is that, that angst caused by, watching your neighbor get rich, right? Mm-hmm. Nothing's more powerful than watching your neighbor get rich. If other people are making money, you can ignore it for a little while, but if the bubble goes long enough, everybody has to participate. And that's where we're seeing it today, right? If you want to work in a financial services industry, you got to jump on board. If you want to be a financial advisor, you got to jump on board, a fund manager, whatever it is. You can't not participate in the bubble. And now we're seeing Bitcoin with futures and everything else where everybody's feeling they've got to participate in that also. So I think the bubble is a lot of time, it's just the fear of missing out on making easy money. So that probably simplistically explains a lot of these bubbles throughout history.
Yeah, good old FOMO. And FOMO isn't just fear, it's also greed, right? It's your fear of not being able to cash in on your greed.
Yeah, well said. Exactly.
Yeah.
Exactly.
And that's like really anathema to thousands of years of human development and thousands of years of emotional development. It's a very primitive kind of emotion. of that fear of, like you said, missing out, that fear of not catching the wave and that there'll never be another wave. This is your last chance. If you don't jump on now, you're never going to make it, right? And yet it works like a charm every time.
Yeah, you can't miss out. You have to join the crowd, right? If the crowd's making money, if you're not making money, then there's something fundamentally wrong with you. So these are powerful dynamics. And Kerry, I think one of the things that is not really appreciated as much as it should be, actually, I think it's appreciated very little. I argue that we're in a unique period in history. And basically, for the first time ever, this is an experiment in unfettered finance. I mean, if you look at finance historically, you either had a gold standard or, let's say you had Bretton Woods, you had some type of a monetary regime, you had the dollar standard, you had things that restrained credit growth. And importantly, historically, the banking system was one of the main sources of credit growth for economies. And banks and bank credit were restrained by capital and reserve requirements. Well, what we've started over the past 30 years, and it's evolved over more dramatically over recent decades, is we have complete unfettered finance, market-based finance outside of the banking system. So basically, there's no restraints at all globally on the quantity or the quality of credit. We've seen the Chinese banking system go to almost $35 trillion, and that's from $8 trillion during the 2008 crisis. So this has totally distorted everything where you have unlimited finance. And it used to be if you had strong demand for credit and you had a limited supply, the price would go up, which makes sense, right? That's the way the pricing mechanism works, right? That's how capitalism works. Well, throw that out. We can, central banks can create credit. The so-called shadow banking system can create credit. China, the emerging markets, everybody can create credit. So there's no pricing dynamic, right? You can be all the demand we want for credit and the price can go down. And that was the key to the whole mortgage finance bubble, right? We quadrupled the amount of annual mortgage credit growth that we had, and the price went down. Why? Because the financial system just leverages and everything else, and you have unlimited supply of credit. And that's changed the world, and that's changed these bubbles. It's changed policymaking. It's changed everything. But again, very few people appreciate what a profound change this has been.
Yeah, it really is profound. So there's no limitations on financial behavior as we once knew. There's no checks and balances. Everything is kind of free to go exponential, and the markets have followed effectively.
Exactly. And markets are all about greed and fear. And if you take fear out of the equation, which is what unlimited finance backed by central bank balance sheets, if you take fear out of the equation, you're going to have greed. And it's greed with unlimited finance. And again, I think when people look back at this period, they won't understand how this happened and how the central bankers actually thought this made sense. But that's where we are today.
What about the behavior of the Wall Street insiders and the market participants? There's a lot of reprehensible things going on here.
Well, of course. And Kerry, read, again, throughout history, the different financial fiascos. If you have an environment where you can create billionaires, multi-billionaires through financial speculation and shenanigans, well, of course, they're going to do it, right? To me, it's just a consequence of unfettered finance and these central bankers that are backstopping an unsound system. And let me throw out also, while I'm on this tangent. So I'm saying this is a unique period in history with all this unfettered finance. That experiment almost failed multiple times and then basically failed back in 2008. And it was resuscitated by this experiment in central bank monetary stimulus, QE, negative interest rate, yield curve manipulation, all of this. So you've had a failed experiment in finance. Now you have this, what I fear is going to be a huge failure in central bank monetary management that's in response to the failure of the financial experiment. So it's kind of an experiment on top of an experiment.
Yeah, an experiment that's really gotten out of control. Like you were trying to split the atom in your home laboratory, and all of a sudden it went critical and took out your neighborhood, right?
Yeah, but everybody thinks that it's healthy, and that's what's amazing is you get very little skepticism for how this is unfolded. And Janet Yellen, for example, who's had a great career in public service, so I don't want to criticize her, but she is held in such high regard. And for 4 years, she failed to tighten financial conditions as this bubble just gained, powerful momentum. I think that's inexcusable for the head of a central bank, especially after seeing the damage that came to the system after the last bubble. So I'm a little perplexed as far as, this positive attitude about central bankers today. Although, if people are making money, of course, they're going to, I guess, celebrate central banking.
Yeah, it's the greatest thing since sliced bread. So anyway, I guess the whole premise here is that nothing lasts forever, and we're going to see probably sooner rather than later these bubbles blow up. Do you think humanity will learn something at that point, or do we have to repeat the process and keep repeating it till we get it through our heads that there's no free lunch?
Right. I started writing my Credit Bubble Bulletin blog back in 1999. I was convinced there was a bubble. I'd had conversations with a few officials at the Fed. They did not see it. I thought when that bubble burst, they would recognize this new type of finance that had evolved, and they would work to rein it in. Well, little did I know, I thought the bubble burst in 2000. I had to change my tune in 2002 in my blog. I think it was March of 2002, and I started arguing, wait a minute, this could be the unfolding mortgage finance bubble. Then I followed that through on a weekly basis. I thought the bubble burst in 2008. Well, I think it was April 2009, I had to change my tune again in response to policy, the aggressive QE and interest rate policy, and said, wait a minute, well, what we could be seen as the global government finance bubble, and then I've referred to it as the granddaddy of all bubbles. Mm-hmm. So this bubble has gone global, which is very important. China, as an analyst of credit, I'm in awe of China and their credit bubble, but it's also gone throughout virtually all asset classes at home and abroad. So this has become very dangerous also because the heart of this bubble is in what I refer to as the heart of money and credit, the foundation of money and credit. It's gone into central bank credit and sovereign debt. Mm. So you get this dynamic where you get officials just this past week. Chair Yellen and Mario Draghi were both arguing, we don't believe it's a bubble because we don't see the leverage. Well, I'm sorry, the leverage is in central bank balance sheets. It's in government balance sheets. And I also think, importantly, it's in securities finance and derivatives finance. And I think there's a huge amount of leverage globally that's creating liquidity into the markets. To me, it's inevitable that this bursts because you can't continue to create all this credit and misprice it like we're mispricing today. It makes the mispricing during the mortgage finance bubble look like nothing, right? You have negative yields in Europe. We're doubling, tripling the amount of government debt and reducing the interest rates they pay, reducing the risk premium. So bubbles inevitably burst. This one's very problematic because when it bursts, basically you're just going to get more central bank credit and more government debt. And at some point, the market's going to protest and say, wait a minute, I don't know if I'm going to get paid back, or at least you're going to have to pay me a higher risk premium to hold this rapidly inflating paper. So to me, and I hope I'm wrong on this, Kerry, but to me, this is, having watched this for 3 decades, this is the worst case scenario that's unfolded. And I think when it ends, it's a disaster.
Yeah, I'm inclined to agree with you. It's going to happen. We don't know when. We never know when these bubbles are going to pop, and anybody who claims to know is invariably wrong. But it more or less has to happen because the tree doesn't grow to the sky, right? Nothing goes up forever. I mean, companies that we've seen in the past, the IBMs, the Microsofts, Google and Facebook, and those are still going up, but nothing goes up forever. Eventually, there's a life cycle to everything, right? There's always a life cycle.
Right. And the nature of these bubbles, and we've seen it repeatedly, things go crazy at the end, right? It's just manic market blow-off, speculative blow-off. That seals the bubble's fate, right? Mm-hmm. You had the mortgage finance bubble, double-digit mortgage credit growth, 2001, 2002, 2003. By the time 2005 came around, was like, wow, this is an incredible bubble. Well, that didn't stop $1 trillion worth of subprime CDS, credit default swaps in 2006, which basically sealed the fate for subprime. Because once you have that final mania and that final crazy amount of credit, speculative excess, the elevated asset prices, it's just not sustainable. It's like anything in life, right? Once you get that excited about something, it's not possible to sustain it. When all of a sudden you get some risk aversion, then that can quickly lead to a change in the cycle. I mean, we saw back in 2000, we saw it in late 2008.
Yeah.
So these things are repetitive, but people always get so excited during what I call the terminal phase that they take their eye off the ball and they forget to do real analysis and look at things with a little bit of common sense.
Yeah, fear of missing out becomes fear of going broke or losing all your profits. And all of a sudden, everybody runs for the door at the same time. Like cryptocurrencies, how deep, how liquid is the market really for these coins? I wonder about it because I think it's really a case of, especially in Bitcoin, just not being a lot of supply and the hype just getting out of hand. I guess we're going to find out about this soon enough. If you had to pick a bubble of the numerous bubbles out there, which one do you think will pop first, Doug?
It's difficult to I think China is on the top of the list. They're trying to tighten credit. They've been timid tightening credit for 5-6 years now. I think they're to the point where they realize that they've got to take more determined efforts to slow down credit growth there, especially in the household and corporate sector. So China's on the top of my list. And in fact, it may have already started. Those stocks in China have been performing, they've been underperforming many other markets around the world. And I think if China pops, then that will be a global catalyst. Right now here in the U.S. with, the tax legislation passing probably this week, there's a lot of euphoria in the U.S. markets. But even now we're already seeing, some weakness globally in equities, in Europe, Asia, China in particular.
Yeah. So there's a lot of bubbles to look forward to blowing up. They're all going to have their day eventually. And hey, if you're blessed enough to be in there, you never go broke taking a profit. And I just always remember what Bernard Baruch said about his success during the Great Depression. And he said, I got rich letting the other guy make the last 10%, right? And
isn't that the truth? Yep.
Isn't it? It's so beautiful in its simplicity, and it always works, right? It always works that way because the dumb money gets in the last minute, right? And then they get slaughtered. Lambs to the slaughter. Well, bubbles, I love studying them. One of my favorite bubbles is the Kuwaiti stock bubble, if you remember that one. It's one of my favorites.
Blank checks, right?
Yeah, because, hey, like anybody could just write a check that's worthless, right? But they traded, and if you're not familiar with the Kuwaiti stock bust, it was a mass thing where everybody bought stock, foreign stocks on the exchange there, but they bought them with post-dated checks. And then what happened was the first guy's post-dated check bounced, and then all the other checks bounced, and they had to bail out the country, right? To make a long story short, pretty accurate.
Oh, absolutely. Yeah. And as you've mentioned, it's always about the liquidity, right? And during that manic final terminal phase, it seems like there's liquidity everywhere. And part of that liquidity is, speculators leveraging to buy securities.
Yeah.
Well, when you have that reversal and the risk aversion, the panic, all of a sudden you have an unwind of that liquidity.
Yeah.
So liquidity can evaporate quickly. And I mentioned China as a potential catalyst, but the real heart of the problem is in liquidity. I would say specifically the derivatives markets and ETFs are both derivative accidents waiting to happen.
Yeah.
There's been this whole trade. Everyone's basically writing flood insurance during a drought, and in writing market risk insurance and taking the premiums because central bankers were out there not allowing a crisis. So that's led to huge distortions, and the cheap insurance has led people to go out. Why not speculate if you can easily hedge with cheap insurance?
Yeah, everybody.
And the ETF, the ETF complex is just an accident waiting to happen because you've had literally trillions flow into these new instruments, basically, and with the assumption that they're always liquid. And a lot of these ETFs will invest in illiquid securities, especially in corporate credit and small cap stocks. And it works wonderfully as long as all the money is coming into the ETF complex. But down the road, I don't know what happens. All of a sudden, there's a big reversal in these funds, and people want their money back, and these funds hold illiquid assets. So, yeah, this liquidity issue it's going to be something we're going to have to live with for years to come, unfortunately.
Oh, yeah. Yeah, the fallout, that's what many of you don't realize, is the fallout from a pop bubble. It doesn't just like, the markets go down 50% in a month and then everything's fine. No, investment dries up, liquidity dries up, then you have issues perhaps in housing, and then the government will double down again, Doug, just like they did in 2008 and 9 to just backstop every mortgage that's written to keep the market somehow chugging along. Well, you wonder next time, is it going to be that easy for them?
Well, that's right. And that's why I refer to this, as the granddaddy of all bubbles. This will be the final bubble in a lot of ways because it rests on the premise that central bankers can make everything good. There's this confidence that central bankers can keep the markets liquid. They can keep prices elevated. The economy's chugging along. It reminds me a lot of, Washington will never allow a housing bust. The West will never allow Russia to collapse. You always get these types of misperceptions. Well, when this misperception it comes to fruition here, people won't trust the central banks again. And then this long cycle of these reflations, these policy-induced reflations, I think it's going to be much more difficult to reflate the system next time because people are going to be very leery that central bankers are doing the right thing.
Yeah, look, it took $16 trillion to do it this time, just so it didn't fall apart and hit the rocks, if you will. Implosion. We were that close. 16 trillion. Is it going to take 160 trillion next time? And where is that going to come from? What happens if you try to print that much up? I don't know the answer. Anyways, what I do know is you should check out Doug's site. It's a really good site. A lot of insightful analysis. The name of it is creditbubblebulletin.blogspot.com. Hey, just send us an email. Be part of the show, kl@kerrylutz.com. And, of course, the Twitter feed's @KerryLutz. And the Facebook page is Financial Survival Network. Doug, it's been a real pleasure. Appreciate you coming on, and we'll definitely have you on again. Be well, and happy and healthy New Year to you and yours.
To you, sir. And thanks so much, Kerry, for having me on. I'll look forward to chatting soon. Take care.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.